Hey everybody, it's Seth's show. My co-host is Paul. We're here in Richfield, Ohio. But Paul, I tell a lot of people when I talk to them, I'm from Akron, Ohio. Damn it, I love Akron. You adore Akron. Your new home is, oh my God, Paul, that home is in a very staple road of Akron. It's super.
So can I tell you a little story?
Go on.
Yesterday I was on a phone call helping some guys do real estate, and
you doing calisthenics over there?
I don't know what I'm doing. And a guy, and they said, I said, where are you guys at? They're like, we're in Bath. I'm like, wonderful. I'm in Richfield, blah, blah. And then, they're like, how long have you been in Richfield? I said, 12 years, but I'm moving to West Akron.
Yes.
And the one guy goes, what'd you buy in West Akron? I'm like, I bought a nice house. I really couldn't turn it down. He's like, did you buy it? I was like, yeah, I bought it. He's just like, that's incredible.
We'll be doing live shows from the swimming pool out back in Paul's new mansion, and it's just incredible, Paul. I'm very excited.
It's a 100-year-old home, which I never really thought I'd own a 100-year-old home.
Yes.
But when it came for sale, a friend of mine sent it to me, and I was like, oh my God, I got it.
Why do I consider it my house so much, Paul?
You're welcome to, because...
We're here talking about Goodyear.
By the way, if you want to rent it out for an event, I will rent it out, and Seth and Beth will be your...
coordinators.
Your host.
We're talking about Goodyear. This is why we're talking so much about Akron, a staple of this city and this state for 100 years, this is the first CEO of Goodyear was the one who built my house. Built your house.
Yes.
So we're talking about Goodyear. We have dear friends who work for Goodyear. My grandfather worked for Goodyear for 60 years. That's right, 60
years.
That's right, 60 years. And so this is near and dear to my heart. Now, I owned this stock a few years ago, Paul, but up until recently, it was a pretty boring. From my vantage point, it seemed like a pretty boring stock that wasn't doing much and just wasn't as flashy as some other ones. However, they just bought out their rival Cooper Tire. Is that right, Don? Cooper Tire?
Yes, Cooper.
They're a privately held company, weren't they?
The deal was for $2.8 billion.
Was it?
And sure enough, I got some texts and chats that the stock price is going to the moon here, and so I thought, why not analyze it? If you're interested in, I would say less flashy stocks, this might be one of them. And so we're going to use our 8-pillar approach to look at the health of Goodyear. Obviously, they must have had the free cash flow to buy this company, to buy Cooper Tire, Paul. And so why don't we look at it? What do you say?
Yeah, and we should look at Cooper Tire, too.
Oh, good deal. All right, Goodyear. What is the market cap for this wonderful tire company in Akron, Ohio?
So this is a little tough one right here already. We're at $4 billion market cap. Now, guys, their revenue is $12.3 billion, which is a lot. So to have a market cap of 4 when the revenue is 12.3 is a pretty low market cap. But then you see why a little bit. Look at their net income, Seth.
Oh, minus $1 billion.
They lost $1.25 billion last year. Now, granted, last year was probably a crazy year.
Yep.
We'll look at their other numbers later, but they obviously have a negative PE, which isn't possible, so it's an X there, and a negative profit margin X there.
So this is pillar number 1 and 2, which is PE ratio, price to earnings, and profit margin. We're at two X's here. Go ahead, Paul.
But look at their free cash flow last year, $411 million. So they still had positive free cash flow, probably a change in working capital, and their dividends paid last year was $38 million. So they're able to cover their dividends still. They'll probably keep it, but this is another example, guys, of understanding, is a company able to actually afford their dividend? Because dividends are not guaranteed. In fact, companies use the dividend as a way to get people to invest in their company. If they're struggling, they might pay a bigger dividend by borrowing money or issuing more shares to get investors in to go, oh, look, there's a big dividend. But either way, the dividend's pretty small. But right now we have 2 X's. Very bad gross margin, only 16%. So far I'm kind of like, but let's go on forward.
I would say, the thing they're doing now, Paul, is they're doing mobile tires. So on Saturday,
I freaking love that.
On Saturday, they're coming to my house, bringing the truck and I'm putting tires.
The problem I had was when I wanted the tires, it was a 6-week wait because everybody in the world wanted tires that time.
I see. Yeah.
But I love it. I think that's like the most genius. Like to me, the future of the world is come to your house and get something done. People will pay to just not have the inconvenience of going out there.
Yep,
I called Ryan. I'm like, Ryan, how do I get on this? He's like, Paul, the wait's like 6 weeks. I'm like, don't they know you're the CEO? He's like, I'm not the CEO. I'm like, well, then why am I friends with you? I'm just kidding. I did not say that.
Pillar number 3 is revenue growth over the past 5 years.
Okay, so this is where we have a problem. 15.16 down to 12.3. But here's the deal, Seth. 2011, they did 22.77. It just keeps going down. Now, I don't know why that is, but you have to understand, why is their revenue down almost in half over the last 10 years? Now, a company that's not growing and actually decreasing in size can still be a good investment. As an example, can I give my example, Seth?
Please do.
Because what do I always talk about with this point?
Well, I know where you're heading with this, and I like when you do this graph, but you talk about how there is money that's going to be made in the future, and
potentially.
And what do I pay for it? At what cost can I invest and maybe make money out of this, even on a dying company?
revenue and profit. Let's say a company with 10, 8, 6, 4, 2 in revenue and profit of 5, 4, 3, 2, and 1, hypothetically. Are you telling me you wouldn't pay something to get $15 in profit, 5 plus 4 plus 3 plus 2 plus 1? Of course you would. You would pay, that's $15 you're gonna get. Would you pay 5? Of course you'd pay $5 to triple your money over the next 5 years. It doesn't matter if it's dying or not. That's the whole idea here. There's still value to something that's dying, but you have to make sure you pay the right price for something that's dying. Right now, the 500-foot view of Goodyear is they're a dying company. They went from $23 billion. Now, they could have just sold divisions off, and that could be the reason, but usually that comes in big jumps, big drops. This was a very consistent drop, which kind of concerns me.
That's true. All right, so profit growth. We're on pillar number 3.
Okay, so let's look at the profit growth relative to their, let's go to our trusty Everything Money website. Okay, 1.26 billion to a loss of 1.25 billion. That is an X. Now, go back to the last 10 years. As their revenue was dropping, their profit was staying moderately the same. I mean, a couple big years here or there. So maybe this wasn't the worst idea. They lost money in 19 and 20. You see right here. That's interesting. So this is all over the board. This is something to talk about. Like, look, they did $22 billion in revenue in 2011 and made 340. They did, in 2007, was it 2017? 2017, they made $346 million, which is more on revenue of 1/3 less. Do you follow what I'm saying here? It's just, this is part of the understanding of like, okay, maybe they were just being inefficient before and they're trying to become more efficient now. Maybe I don't know what they're doing, but this is one of those weird companies where they have a big loss last year. We have to figure out why.
Unfortunately, we're at 4 straight X's. Pillar number 5 is shares outstanding.
We have a winner. Finally on shares outstanding. $1.05 billion to 937. Check mark there.
Okay, the shares are going down. Current assets over current liabilities is pillar number 6.
Cash on hand, $5.7 billion. Total current liabilities, $4.89. So it's a check mark there. The one thing I don't like about this company, I'll say, there's a lot of debt. And the debt's not going down. Even though the revenue has dropped almost in half, their debt is actually up over the last, that's 10 quarters. Let's look at years. We can't look at years right now. There's a little bug in the system. But bottom line is, their revenue is going down, their debt's going up. I don't like that.
This is the Everything Money software that our Patreon members get. You can be a Patreon member. We'll talk more about it at the end of the video. But this is software we're beta testing at the moment. It'll be released in 2 months. And so patrons will get a sneak peek of this, of course, very soon. And top tier has already been playing with it, right, Paul?
What was that?
Our top tier patrons have access to this.
I've given access to our top 29, 30 patrons, and they're loving it. And surprisingly, they haven't reported many bugs. I've found most of the bugs.
Yeah. Pillar number 7 is free cash flow growth. This usually weighs a lot in your mind.
Yes. Free cash flow, cash from operations, less your capital expenditures. I look at this way more than net income because free cash flow, it's harder to lie about free cash coming in, cash coming out, than it is net income. And net income is affected by IRS laws, tax code, etc. Free cash flow is cash in, cash out. They use this free cash flow to pay dividends, buy back shares, make acquisitions.
Like Cooper Tire?
Correct, like Cooper Tire. Now, here's the deal. What I do, I actually make the software so it just calculates the free cash for you. Free cash flow is not part of the investing section of the cash flow statement, but I put it in there for our users. They had a negative $373 million in free cash flow to a positive $411. That's a check. But look at this all over the board, Seth. Do you see how all over the board their free cash flow is? Yeah. 44, 475, 145.
Yeah, the average is 140.
So 140. Oh my God, this is a dying company.
Uh-oh.
I'm gonna tell you right now, times 20 is 2.8 billion.
It's a $4 billion company right now.
So it's overpriced right now. So it's still an X there. And I'll be honest with you guys, it's very, very rare that I say avoid a company, like flat out avoid. I shouldn't say very rare. I rarely say buy or avoid. I'm avoiding Goodyear. Like immediately when I'm looking at this company, I'm going, I'm out. Because there's too much all over the board. There's declining revenue. It's not one of those situations where I go, it's declining revenue, but it keeps making money and the free cash flow, I can put a value to it. There's too much debt. The debt's going higher and higher. The revenue is down 30, almost in half. I just don't like the feel for it. Like I just look at it going, There are 10,000 companies out there I can choose from. Let me go find another one.
So the question is,
and for those of you who join our Patreon, you get the Everything Money app for free. It's only $13 to join per month to join Patreon. You have this page, which just tells you the whole. By the way, this is wrong. Here is a bug. The PE is actually an X because it just the way it's coded right now. So there were only 3 checks outstanding.
So Paul, I guess the question is, at the turn of the year, the stock price was 40% less. So obviously with this big news, we get a big jump. Was this company a buy just 3 weeks ago?
I don't think so. I wouldn't have bought it, and I would have missed out on that jump. And I would not have bought it here either, and I would have missed out on that.
It's just too all over the place.
It's just way too all over. I look at it going, with a debt, like if there was no debt involved or very little debt, I'm like, okay, I don't know their assets. They could have factories all over the world that are worth something great. That's part of the due diligence that you have to do. But my goal is to weed out companies quickly. And I saw these numbers, and they're not. I don't sit there and go, oh wait, but this could be. It's just too all over the board. It'd be one thing if profit was going like this, and then all of a sudden one bad year, and then started to rebound. It wasn't that. Profit was like this. I mean, profit was all over the board, and I was like, cash flow is all over the board. Are we gonna have $800 million in free cash flow next year, or lose $300 million in free? I don't know. And I don't see a consistent pattern to it. Even this can have a pattern, right? Even ups and downs. So I'm just choosing myself to just move on from Goodyear.
Okay, so Paul, let's just look at the acquisition of Cooper Tire. What kind of company and company health behind Cooper Tire that just got acquired? What do you think?
I'm gonna tell you right now, already better than Goodyear.
Come on.
I mean, let's look at it. Okay, so $2.9 billion market cap. So it's already almost as much as Goodyear.
Yeah, $4 billion for Goodyear.
Now it only has $2.5 billion in revenue. Goodyear had $12.5 billion. So it's 1/5 the size, and the market cap's huge. Net income, they actually made money last year, $156 million. Their free cash flow last year was $407. So the big difference in free cash flow to net income. PE, first metric, check mark, 18.4. Profit margin, X, 6.14%. So we have a check in an X, and we have a dividend yield of 21 million, which is a dividends paid of 21 million. It's a very small dividend, guys. It's what I call an adorable dividend, 0.74%, but it's easily supported right now on its free cash flow.
Pillar number 3 is revenue growth.
Let's go to the revenue. Let's go to the income statement, and let's go to 4 quarters. We have 2.92 billion to 2.54 billion.
Slowing down.
So that's an X right there, guys. And look, 10 years ago, it was 3.77. Man, the tire business is tough.
I don't know why they're making so many cars.
Maybe it's being outsourced a lot to China. One of our good friends is a tire dealer that does a lot of China stuff.
That is true. I've been seeing that, right?
Yeah. 238 million in net income to 156, another X. Okay, I'm not liking the way this is going, but look at the last 10 years. It's profitable every single year. Do you see that, Seth?
Consistent,
and I'm gonna look at the free cash flow and make sure that's also been consistent.
Pillar number 5 is shares outstanding. We want this going down.
It is going down. 220 to 201, check mark. It's not really 220 and 201, but...
You get a little froggy there?
Yeah, you like that?
That's
total current assets,
yeah,
1.54 billion. Total current liabilities, 640 million.
Okay.
Check mark there. Oh, total liabilities of 1.53 billion. So they just have enough money to pay off all their debts. This is my favorite thing when I see that. They have more cash on hand than all of their debts combined.
Only the second check, Paul. Pillar number 7 is free cash flow growth.
So again, free cash flow, guys. We got to go cash from operations less capital expenditures.
Look at this one.
70.8 to 407. It's a check mark, guys, but this is
all over the place, Paul.
Yeah, and it's so inconsistent. Like, they've never had 400 million. It was a change in working capital, I guarantee. Yeah, it is. I just look at it going, oh my God, this is... I'm going to take out last year.
$1 million in 2019?
Yeah, $1 million. Let's go to the...
Come on.
And look at this. They had really consistent growth. They had good things going here. And all of a sudden, poop.
So why is Goodyear buying this?
I don't know. There might be some synergy they can do and save a lot of money. A lot of companies will acquire other companies saying, hey, we're a tire business, you're a tire business. We don't need all your employees. So we're going to incorporate it. We're going to save $600 million a year in expenses in addition to adding $400 million into it. So we're going to add $1 billion a year into our profit. I don't know. That could be the reason.
I mean, I think prior to this acquisition for Goodyear, it looks like Cooper had a higher market cap, or at least very close to the same market cap.
They also jumped up a lot too.
Okay. I mean, I'm trying to figure out why they would buy this, get rid of competition.
I don't think it's get rid of competition. Usually when companies are dying like that, like Goodyear was, they can sit there and go, okay, if we add this company and we save costs, we can go from $600 million, we can add $600 million to our bottom line because we can get rid of a lot of employees, a lot of factories, a lot of things like that. I don't know what the reason is. Go look at it, do some research on it. With Cooper Tire, it's just, what's up, Don?
I just have a question.
Let's hear it.
Go ahead.
So when Goodyear absorbs Cooper Tire, do they gain their? How does this all play out as far as numbers go?
Well, I don't know if it was a cash transaction. They're just buying all the shares out from all the investors, or they're doing an exchange of shares. But the company just becomes part of Goodyear, and that's it. I don't know what happens.
Yeah, Cooper shareholders will receive $42 a share in cash and $1 and 0.9 shares of Goodyear. So they're getting a smidge of Goodyear, or about $54 a share in total.
Oh, and currently Cooper Tire is selling for $57.
Mm-hmm.
So how does that factor?
Yeah, I don't know. That's
how does that even happen? So they're basically getting $54. Oh, because Goodyear stock is up a lot still too.
Yeah, I mean this article is a couple days old, but
okay.
Yeah.
So yeah, that's what happens. It's just it's a pretty common thing in the corporate world. Remember, a lot of CEOs want to sit there and look like they're being very active by making acquisitions. This might be the right acquisition. I don't know. It's just, I mean, I like the financial health of the company in the sense of their balance sheet. Their balance sheet looks pretty good. The fact they have more cash on hand than total debt. That the free cash flow number is kind of weird, but either way.
If this style of looking at companies, looking at the math speaks to you, we welcome you to join our Patreon. Our Patreon page has exploded. We have over 1,000 members. You each get your own Discord community and channel, your own chat, and there's tons of messages, 1,000 messages a day going in and out. You can bounce ideas off other members from all over the world, and they all kind of think like you. So if you feel alone out there in your investing journey, which I always say I did for a long time, feel free to join our Patreon. We are giving away 2 Teslas to patrons this year when we hit 50,000 subscribers and 100,000. Yes, you heard that right. It's completely absurd, but Uncle Paul is swiping his credit card for 2 Teslas for our patrons. So get in on the action. We love you, Paul. That was our take on Goodyear and Cooper.
Do you want to hear a funny text I just got?
Please do.
Congratulations on getting married.
Oh, yes, your beautiful new girlfriend.
No, this is a random person who really thought I got married.
Yeah.
No, they don't even know about this new girlfriend. They don't even know a clue. I'm like...
Oh.
They just said I got married.
Congrats.
I did not get married.
Tickle that thumbs up. Subscribe. We love you guys.
I think everybody in this room would be invited if I got married.
Oh, nice. Love you guys.